Today, we're going to pull back the curtain on a story that most of the headlines completely missed. It's a story about a huge market rally that, on the surface, seemed to defy all logic. Let's get into it.
That's a pretty heavy statement, isn't it? It kind of forces you to second-guess the stories you're being told and to start looking for the real forces that are moving the markets and your money.
So, who exactly is using fear as a tool, and what's their goal? We're going to follow the data to see how, during a time of absolute maximum panic, some of the biggest players on the field were making their most confident moves.
All right, to really understand what happened, we've got to rewind the clock. We need to go back to a moment when it felt like the entire financial world was just holding its breath, completely braced for a crash.
The story out there was just doom and gloom. You couldn't escape it. Every news channel, every social media feed, it was all amplifying this one single message. Be afraid. Be very afraid. Investors were told to get ready for impact, and you know what? A lot of them did, selling off their assets because they thought a crash was right around the corner.
But here's the crazy part. Right at the peak of all that fear, the markets didn't crash. No, they surged violently. It was a move that left most people just scratching their heads. Unless, of course, you knew where to look.
And that right place, that secret ingredient, is the single most important and honestly most overlooked force in finance today: liquidity. Now, this is a fundamental shift, a huge deal. Before the 2008 financial crisis, you could look at company earnings and get a pretty good idea of where the market was headed. Not anymore. Today, the flow of money is king. If you really want to know where the S&P 500 or gold or even Bitcoin is going, you have to follow the liquidity.
In the simplest terms, liquidity is just all the cash that's sloshing around inside the financial system. When there's more of it, asset prices tend to go up. When it dries up, prices tend to fall. It really is the fuel that makes the entire machine go.
So, where does all this fuel come from? Well, it's mainly two sources. You've got central banks, like the Federal Reserve here in the US, that can literally create money. And then you have government bodies like the US Treasury, which controls how government money gets spent in the economy. These two institutions, they hold the keys to the whole kingdom.
And now we get to the main event. Because during that 1 week of peak fear we talked about, these institutions opened the floodgates in a way that almost no one was talking about.
Let's zoom right in on that specific week, April 1st to the 8th. The public story, the one on TV, was all about geopolitical deadlines and market panic. But behind the scenes, something else was happening. Something that was about to change the entire game.
First up, the Federal Reserve. As part of its normal operations, it injected about $15 billion into the system that week. Okay, this was kind of expected, part of the usual background noise. No big surprise there.
But, and this is where it gets wild, in that exact same week, the US Treasury unleashed an additional $89 billion. This was not background noise. This was a tidal wave of cash, happening at the precise moment of maximum public fear.
And this is the hidden story. You add it all up, and more than $100 billion of fresh cash was pumped into the market in a single week. So while the world was watching the scary movie on TV, the theater itself was quietly being flooded with cash.
So what happens when over $100 billion just suddenly appears in the system? It has to go somewhere, right? And you can bet the smart money, we're talking the large institutional players, knew exactly what to do with it.
The process is actually surprisingly simple. The cash from the Fed and Treasury makes the big commercial banks' reserves swell up. That extra money then gets passed to their biggest clients, the large funds and institutions. So these strong hands, now totally flush with cash, look out and see a market full of regular investors selling in a panic. For them, it's the perfect time to buy. And boy, did they buy.
So you ended up with two completely different realities happening at the exact same time. The public was being fed this story of crisis and panic and every reason in the world to sell. Meanwhile, the insider story, the one hidden away in the data, was about a massive cash injection and just overwhelming confidence.
And hey, if you need any more proof, just look at what the corporate insiders were doing. At the exact moment the world was supposedly ending, executives were buying back their own company's stock at an incredible rate. They weren't scared. They were on a shopping spree.
So, what's the big takeaway from all this? Why does this 1 week matter so much? Well, it reveals a fundamental truth about the information we all consume every single day.
There's this huge gap in the information we get. The public narrative, the one driven by fear and scary headlines, is everywhere. It's blasted at you from all sides. But the underlying data, the liquidity flows that actually drive the market, is barely mentioned. It's not exactly a secret, but it's definitely not the headline.
This just sums it all up perfectly.
That rally wasn't irrational. It wasn't a fluke. It was a perfectly logical reaction to a $100 billion piece of good news that was just completely drowned out by all the noise.
And that leaves us with one final question to think about. If the data is telling one story, but the headlines are telling a completely different one, you really have to start wondering, who are those headlines actually designed to serve?